Overview of Fixed Income Investors. Welcome, everyone. Today we are shifting our focus to the demand side of the market, the investors who provide the lifeblood of global finance. At its core, the fixed income market is a massive mechanism that connects borrowers or issuers with lenders who are our investors. These investors provide essential capital today in exchange for a promise of steady, predictable cash flows in the future. It is important to note that this market is overwhelmingly dominated by institutional investors. Because the capital requirements for participating in major bond offerings are so high, often requiring millions of dollars for a single block trade, it is difficult for individual, retail investors to buy bonds directly. Instead, retail participants typically enter this market indirectly by investing in mutual funds or ETFs. As you can see in our overview diagram, global capital flows through the fixed income market to reach those who need it. On one side we have the borrowers, and on the other, the lenders. Notice how the lender side is further divided into institutional players, like pension funds, banks and insurers, and retail players, who mostly access the market through mutual funds. As a trainer, I want to emphasize that understanding this who's who of investors is not just academic, it tells you why markets move. Different investors have different rules and motivations. If you know who is buying, you can often predict how they will react to changes in interest rates or economic news. This understanding is the first step in mastering the demand side of the global debt markets. Institutional investors, pension funds and insurers. Pension funds and insurance companies represent the single largest and most influential investor groups in the fixed income world. In the industry, we often refer to them as captive buyers. Why captive? Because their primary goal is not just profit maximization, but asset-liability matching. For example, an insurance company collects premiums today, but knows it must pay out claims many years down the line. Similarly, a pension fund must ensure it has enough cash to pay retirees decades from now. To manage this, they must buy long-term bonds that produce cash flows matching those future payouts. Their investment horizon is typically very long-term, which provides a stabilizing force to the bond market. Interestingly, because their need for long-duration assets is so high, they will often continue to buy long-term bonds even when yields are extremely low or even negative. Following the sequence diagram here, you can see the cycle of capital. Policyholders pay premiums to the insurance company. To ensure they can pay claims years later, the company goes to the bond market to buy long-term bonds. This asset-liability matching ensures steady cash flows return to the company, which are then used to fulfill the promises made to the policyholders. For an analyst, this is a vital concept. When you see long-term interest rates staying low despite rising inflation, it is often because these captive buyers are still forced to buy long-dated debt to satisfy their regulatory and liability needs. They don't have the luxury of sitting on cash. They must stay invested to remain solvent over the long run. Central banks as investors. Central banks, such as the Federal Reserve in the US or the European Central Bank, are unique and powerful players in the sovereign bond markets. Unlike a private fund, a central bank's primary objective is not to make a profit. Instead, they use bond markets as a tool to implement monetary policy and influence the broader economy. They participate through what we call open market operations, where they buy or sell government bonds to increase or decrease the money supply in the banking system. In times of severe economic stress, they may engage in quantitative easing QE. This involves large-scale systematic purchases of bonds specifically designed to drive down long-term interest rates and encourage borrowing and investment across the entire country. The flowchart illustrates this intervention logic perfectly. When there is an economic slowdown, the BALA central bank takes action through quantitative easing. By entering the market to buy bonds in massive quantities, they create artificial demand which helps to lower yields. This action simultaneously results in an increased money supply throughout the economy. As a trainer, I always remind my students that central banks are price setters, not price takers. When a central bank decides to move into the market, they have an unlimited capacity to buy, which can overwhelm all other market forces. For anyone trading sovereign debt, keeping a close eye on the central bank's balance sheet is the most important part of the job, as their policy-driven actions can shift market trends in an instant. Commercial banks and intermediaries. Commercial banks are the engines that keep the bond market moving day to day. They hold bonds for two primary reasons. First, they use them to manage liquidity and meet strict regulatory reserve requirements. Because government bonds are highly liquid and safe, they are the perfect buffer for a bank to hold in case of sudden customer withdrawals. Second, banks act as dealers or market makers. This means they hold an inventory of bonds on their own books to facilitate trading for their clients. If you want to sell a bond, you usually sell it to a bank's dealer desk first. Their investment portfolios are typically concentrated in very safe instruments, such as government bonds and high-quality, high-grade corporate debt. Furthermore, banks are creators of bonds. They originate thousands of individual loans like mortgages and package them together to create securitized bonds for other investors. Looking at the class diagram, we see the dual nature of a commercial bank. On one branch, it holds an investment portfolio consisting of government and high-grade corporate bonds to satisfy safety and regulatory needs. On the other branch, it manages a dealer inventory of trading assets to provide liquidity to the market. This dual role makes banks the primary intermediaries in the fixed income world. Without banks acting as market makers, the bond market would be much less liquid and much more expensive to trade in. For you as an analyst, it is important to watch the health of the banking sector, because if banks are forced to shrink their dealer inventory due to new regulations, the entire market can become frozen, making it difficult for anyone else to buy or sell bonds at a fair price. Sovereign wealth funds and hedge funds. Now we look at two very different types of active investors: sovereign wealth funds and hedge funds. Sovereign wealth funds, SWFs, are state-owned investment funds that manage a country's national surpluses, often derived from oil exports or trade. Their primary objective is wealth preservation for future generations. Because they represent the long-term wealth of a nation, they have incredibly long investment horizons and a very high capacity for holding bonds through market cycles. On the complete opposite end of the spectrum, we have hedge funds. These are active, aggressive investors seeking high absolute returns or complex arbitrage opportunities. Unlike the captive pension funds, hedge funds are purely profit-driven. They often use leverage, borrowed money to amplify their returns on even the smallest movements in bond prices. The diagram compares these two entities side by side. An SWF uses national surplus and the long-term horizon to seek wealth preservation. Meanwhile, a hedge fund uses active trading and leverage as a tool to seek arbitrage. As a trainer, I find this contrast fascinating. One is a patient, multi-generational giant, while the other is a fast-moving tactical player that provides a great deal of pricing efficiency to the market. While they have different goals, both are essential. SWFs provide deep pools of stable capital, while hedge funds ensure that if a bond is mispriced, someone will quickly step in to trade it. For a market to function correctly, you need both the patient capital of the sovereign fund and the opportunistic, sharp-eyed trading of the hedge fund manager to keep prices accurate. Retail investors, direct and indirect. Retail investors, that is, individual people like you and me, participate in the bond market primarily for income or capital preservation. However, the way they participate is quite unique. A retail investor can choose the direct path, which involves buying individual bonds. But this is often very difficult. Many bonds have high minimum purchase requirements, often $100,000 or more, and the market is quite complex for a non-professional to navigate. Therefore, the vast majority of individuals take the indirect path. This means they buy shares in mutual funds or ETFs that specialize in fixed income. This indirect method is highly beneficial because it offers professional management, lower costs, and instant diversification across hundreds or even thousands of different bonds. The flowchart highlights these two choices perfectly. The retail investor can take the indirect path by joining a mutual fund ETF, which pools capital to enter the bond market with great efficiency. Or they can try the direct path to buy individual bonds, but as the dotted line shows, they will hit a high barrier of entry. In modern finance, the indirect path has become the gold standard for individuals. As a trainer, I always suggest that unless an individual is extremely wealthy, the diversification provided by a fund is far safer than picking one or two individual bonds. The growth of bond ETFs in recent years has made it easier than ever for the average person to participate in the demand side of this market, providing a vital source of diversified capital that complements the massive institutional players we discussed earlier. Motivations of different investors. To truly master the demand side, we must understand the diverse motivations that drive these different players. We can group them into four main categories. Liability-driven investors, like pension funds and insurers, match assets to future payouts. Their focus is safety and timing. Liquidity-driven investors, primarily commercial banks, hold liquid government bonds so they can meet sudden cash withdrawals from their customers. Policy-driven investors are the central banks who buy or sell bonds not for profit but to influence economic conditions like inflation and employment. Finally, we have return-driven investors such as hedge funds and retail participants who are seeking high yields and capital gains. This matrix organizes these motivations brilliantly across two axes: profit motive and needs. In the low-profit, high-safety quadrant, we find pension funds or insurers. They care about fulfilling promises. In the high profit quadrant, we see hedge funds, who are hunting for returns. On the bottom axis, central banks occupy the regulatory policy space with a low profit motive, while commercial banks also deal with regulatory needs but operate with a profit motive as well. As a trainer, I use this matrix to show you that the bond market isn't just one mood. At any given moment, one group might be selling for a profit, while another is buying because the regulation tells them to. This constant push and pull between different motivations is exactly what creates the opportunities and risks that we see in the fixed income markets every single day. Summary of market demand. To wrap up our session, we can see that the demand side of the fixed income market is incredibly diverse, ranging from individual households to sovereign states. However, we must always remember that institutional investors are the ones who truly dominate trading volumes and set market prices. Their massive size and the specific regulatory requirements they face often create what we call captive demand, especially for high-quality government debt. For any issuer looking to raise money or any trader looking to make a profit, understanding this complex investor base is absolutely crucial. You must know who has the capital, why they want to spend it, and what rules they are following. Our final mind map brings this entire ecosystem together. At the center is bond demand, which branches out into its four major sources. From the top, we see the institutional side with insurance and pension funds. To the right is the official sector, featuring central banks and sovereign wealth funds. At the bottom, we have the banking sector with dealers and commercial banks. And to the left is the retail sector, covering both individual investors and the ETFs they use. If you can visualize this map, you will have a clear mental model of how capital flows into the fixed income world. Understanding the motivations and constraints of these four branches is the key to predicting market movements and building a successful career in finance. Thank you for your attention today. I hope this provides you with a strong foundation in the demand side of fixed income.